Good morning, ladies and gentlemen. Thank you very much for making out here so early this morning to join our morning lecture, despite the cold weather. Although it's a little bit late, let me first extend my New Year's greetings to everyone. I truly hope that you will have the best year in your lifetime for 2011. This morning, I'm very happy to be able to introduce you Dr. A Sinai, who is at the moment a foremost economic and financial forecaster on Wall Street. I suppose many of you may remember that he worked with us here last year about this time of the year. He to give a speech on the outlook of the global economy. Well, he covered many issues in his speech at the time, but I still remember one thing very clearly. That is, he mentioned about the Korean economy and said that Korea would make a 6% growth for this year, for last year, 2010. Well, I was surprised then to hear that because that was about the highest estimate I had heard of by then. But what did we get for the last year? According to the Bank of Korea's estimate, recent estimate, they said it's going to be around 6.1%. So it's pretty close. Well, I am not sure he would repeat the same thing for this year or next year, but I'm sure that he will provide us with some very useful and sensible forecast for the global economy, including Korea. I think in doing so, he will make a very careful review on the current state of the global economy and the policy environment going forward in major economies. And I think he will try evaluate those impacts on the global economy, including Korea hopefully, and financial markets, probably including stock markets too. So that point probably you will have to pay much attention to. I believe many of you are very familiar with his name already because he has been with us now so many years in the past. So I'll be very brief in commenting on him. But as you know very well, he is currently a president and chief economist of the of a consulting firm named Decision Economics, located in New York and Boston and London. And last night I was told that he just recently opened up another branch in Chicago. Well, he has been heading the company for the past 16 years, since 1996. He founded it by himself. And before that, he worked with now so famous name to us for obvious reasons. He worked for Lehman Brothers for more than decades. Well, I was told last night he began to visit Korea while he was with Lehman Brothers. So he worked there as a chief economist and managing director. I thought that last night that if he stayed longer with Lehman Brothers would have had that kind of accident. And before that, he worked for a consulting firm, maybe DRI, Data Resource Incorporated, for more than a decade. So his track record is very, very, very good. And while he was working with DRI, he developed a very sophisticated econometric model for the U.S. economy. Well, as you know, the DRI was founded by the late Otto Eckstein, a Harvard University economic professor, and both of them together worked more than a decade to develop the very good econometric models. So I think he's a kind of living dictionary on this kind of business, making these economic models and forecasting since then. So I think that covers a little bit of his high profile of career, his brilliant career so far. And now let me present Dr. Sinai for your first speech. Please join me in welcoming him.
Thank you for the wonderful introduction. It is a delight for me to see you again at the beginning of a year. I too wish you a very happy and healthy and prosperous 2011, and I wish the country of Korea the very best. Indeed, Korea did very well last year. I probably got a little lucky on that forecast, but in a way I'm not surprised that the results were on the upside of the expectations, because the country is a very dynamic, productive, enterprising country with a huge cadre of people, well-educated, advanced training, and for better or worse, more PhD economists per square foot in a country than even in my own. And so we economists stick together, we're biased, and on average, Korea has done well. Indeed, Korea did well even during the great crises, the financial and economic crises that started in the U.S. and spread throughout the global economy to, during the years 2000, late 2007, 2008, and into 2009, swept economies down more sharply, more deeply than any business cycle downturn since the 1930s. Korea is one of the few countries that came through that episode relatively well, and on an annual basis, annual average basis, real GDP of Korea did not go negative. I think 0.2% was the figure for 2009, 2.3% growth in 2008 after a 5% plus growth rate in 2007. For Korea, that kind of decline in growth was recession-like. But in terms of how the country did relative to other countries around the world, and how Asia did, except for Japan, relative to other countries around the world, the Asian dynamics took the region through the period of time, the crises, in good fashion. But now we are after the crises. The financial and economic crises are over. Almost everywhere. We do have legacies of the crises. But as this year we look ahead to 2011 and a peak at 2012. The 2010 year for the world economy appears as a transition year, a time of moving out of the Great Recession, out of the financial crises and collapse in so many markets and for so many financial institutions around the world, a transition year that bridged the crises to now the prospect for 2011-2012, which is brighter and encouraging, particularly so, once again, for the Asian region of the world, the most dynamically, at least on our forecast, growing, strongest growth areas of the world economy as we forecast and analyze some 47 countries around the world that account for 93% of global output. So this morning I want to look ahead, not behind. Look ahead at the prospects for increasing growth as we move through the year 2000, more or less, not for all countries. Indeed, I don't think Korea will do 6% again in 2011, but our current expectation of 5 to 5% real growth for Korea is still an excellent year, and with some luck and skill in the application of policies in this country, the breaking of the economy and a reduction, attempt to reduce inflation, the business expansion in Korea should extend into and through 2012, indeed throughout all of Asia, and continue for a number of years. South Korea and a number of countries in Asia do not have the excesses and imbalances, the sovereign debt problems of a number of countries in the global economy, countries in Europe, the United States, Japan. Imbalances, an overhang of deficits and sovereign debt that will prevent those countries from achieving the growth that they once were capable of, and allow countries like South Korea, Singapore, China, though there is a question mark because of the inflation in China, Australia, the Asia and Pacific region of the world economy to grow faster, more dynamically than almost anywhere else, and to provide a better and improving business climate that will bring more prosperity to this part of the world than perhaps you have ever seen before. We study the business cycle in the United States and globally. The business cycle and where countries are in their business cycle set the stage, the backdrop for what goes on in business and what goes on in financial markets, in investments, and in the making of money and in the achievement of returns. Last year, the outlook was one of recovery, the early stage in a business cycle upturn for most of the economies that we cover and analyze. And recoveries we had. This year, the prospect is one of expansion. The next stage in the business cycle upturn, it's technically called expansion, follows recovery. It's the phase of the business cycle in a country when the previous peak level of real GDP before the recession is surpassed. In the United States, in the fourth quarter of last year, on our estimates, we surpassed the previous peak real GDP, which was in the fourth quarter of 2007. Technically, from a business cycle standpoint, as measured and monitored by the National Bureau of Economic Research, with which many of you are familiar, that dates expansion. The U.S. is in expansion. It's a safer place than recovery. During the expansion phase of the upcycle, it is difficult to fall back into recession. The U.S. expansion recovery, the U.S. recovery began in June 2009. The time between the recovery and the onset of expansion, that is, the movement of real GDP upward to above the previous peak level, given how deep the downturn was in the United States, was about a year and a half, and that's longer than a lot of recoveries. That phase has been marked by many worries, many concerns that the U.S. economy might suffer a double dip, fall back into recession. That did not happen. At times the risk became reasonably high of a double dip, and will not happen. The odds on this kind of fallback into a downturn are very, very low, because once an economy reaches the expansion stage, it is in, process-wise, a self-sustaining, self-reinforcing, upward cyclical move, very resilient to shocks and problems. The excesses and balances of the past downturn, and that still exist during the recovery, have been worked out. Disequilibria become equilibria, and the expansion is the longest, best part of the up business cycle in an economy. In Korea, there was a quick recovery, and expansion began here in the third quarter of 2009. Korea hardly had a recession. It was more, I think, better called a growth recession. The expansion, beginning in 2009, the third quarter, has been in place here for quite some time. And that was partly why I gave you a high-end forecast for Korea last year, because of the place, in our view, that Korea was in the business cycle. Best part of the upcycle, most resilient, self-reinforcing, self-sustaining upturn, supportive policies, typically, still, policies that are not aimed at slowing the economy down. We are often surprised systematically on the upside during the expansion phase of the business cycle. There are more positive surprises than negative surprises, and the 6% against the consensus was one of those surprises. This year as well, if wrong, let's say 5% growth, probably, given Korea's place in the Asian world, it might be wrong on the downside. Now, the early stages of this year may see some slowdown in growth as the Central Bank of Korea raises interest rates on account of inflation too high relative to the 3% target jointly agreed upon here in Korea by the government and the Bank of Korea. So gentle restraint is being applied through interest rates and monetary policy on the Korean economy, and restraint is being applied in China as well because of inflation picking up too much there, and the same in India, The same in several other countries in Asia. So over the first half of 2011, economies may soften in the growth rate, but we think the inflation problem will pass. Inflation will not dip way down. It will stay higher than it has been for some number of years. But the economies will then regenerate and regrow and move back up to a higher pace of growth for later this year and 2012. Korea has been in expansion, I'll underscore, since the third quarter of 2009. And that was a time when the U.S. was just entering recovery. And other countries were, some of them, still in a downturn. Italy is still in a recovery, has not reached the expansion stage yet. The German economy declined so sharply in 2008 and 2009 that despite a V-like recovery, it has not yet entered the expansion stage of the business cycle. It, of course, will get there. China never suffered a downturn. Neither did India. China and India suffered reductions in growth, but nothing anywhere near a recession-like situation. Indonesia entered an expansion in the second quarter of 2009, and is growing strongly and dynamically now. Thailand entered expansion in the fourth quarter of 2009, over a year ago. And the Thailand economy, despite some of its difficulties, shocks that have buffeted it, is and will show in 2010 over 6% growth, and we think 5.5% growth in 2011. By contrast, countries like Ireland, Greece, Norway, Spain, Portugal remain in recession at this point. The sovereign debt, except for Norway, the sovereign debt problem countries overhang of fiscally irresponsible policies and governments and of high debt loads relative to their economy size that has pushed them to the international lenders and the lending and funds provided by the European Union and forced them to face lender conditionality, which removes from them the ability to stimulate their economy fiscally. They are still in recession. Be happy you are here in Korea and not in Greece, not in Ireland, other than to visit as a tourist. It is very difficult times in those countries. The UK is in a recovery, which started in the fourth quarter of 2009, trying to slow its economy down to impose fiscal austerity because it ran too high deficits of debt as a characteristic for so long. Germany, France, Italy, Japan, Denmark, Denmark, Belgium are in recovery, but not yet in expansion. These are countries, some of them, beset by high deficits, high debt, and trying to struggle through the aftermath of the great financial crisis and great recession that spread through the world. That is where we are in business cycle terms, as we see it. Mixed stages in the business cycle, early, relatively so, in the upswing, and in the case of Asia, aside from Japan, where there are major problems still, likely several years, at least several years, of good times for business, good stock markets. Yes, interest rates will rise, but not enough to stop what's going on. And very likely, the Asian currencies will continue to rise against other currencies, particularly those, what I call the big three, the dollar, the euro, and the yen. But not enough to stall or prevent a very fine business cycle upturn in the dynamics of Asian enterprise from this region leading the global economy forward, this region as the engine of growth for the world economy, not the U.S., not the U.S. in a dynamic sense as the engine of growth. Looking around the world, the U.S. In expansion likely this year, and things are picking up in the United States. 2011 likely to grow 3% plus. That's not bad. Nothing like what we have done historically in business cycle upturns. It's quite good enough given the problems and the difficulties facing the U.S. economy. Canada is in expansion, and it's likely to grow 3 to 4% over the next year or two. The OECD region, with so much of Europe involved, is still recovering, not yet in expansion, likely to get there in another couple of quarters. Similarly so in the European Union. The Eurozone, 17-country Eurozone, still working higher, but because 5 or 6 countries are growing very slowly, in recession, or in some cases, Greece, a depression, the Eurozone economy only up 1 to 1.25%. That's for all 17 countries. Germany will do a lot better. France will do better. But the rest of the Eurozone countries are going to be weak. In the emerging world, the so-called developing country world, emerging Latin America, countries like Chile, Brazil, Argentina, growing dynamically, that will continue. And in Central Europe, a mixed picture for the developing or emerging economies. Strong year for Russia, mixed for what we used to call Eastern Europe in terms of how things will go. Well, in the expansion phase, the upturn is entrenched. It's sustained and sustainable. It's self-reinforcing in terms of the cyclical processes. Those propel and cause the upturn to continue. It's the best and longest portion of the business cycle upturn, the most resilient, without the excesses and imbalances that invite the conditions that bring about a downturn. And the monetary and fiscal policies during this period of time, because expansions can last for years, move from being supportive and particularly for monetary policy, somewhat restrictive. And you see that here at the moment in South Korea. But inflation is not yet a big enough problem for the policymakers to clamp down enough to see the beginning of the next downturn. That cannot be seen by us at this time at all here. Earnings do quite well, and the stock market goes through its most extended bull market run during the expansion in a cyclical or secular equity bull market. And the cyclical bear market for fixed income, that is, interest rates, begin to rise. Not sharply so, but they begin to rise. You should expect in much of the world to see longer dated interest rates, longer maturity interest rates begin to rise as we move forward over this year and into 2012. For investment strategy, broad asset allocation favors equities. Equities are the place to be in the standard asset and asset allocations. We are advising strong overweights on equities. We're bullish on the U.S. equity market cyclically. We're bullish, by and large, on Asian equity markets in a secular sense. That means these equity bull markets will go on longer. It's not just cyclical. It's much longer lasting. And we are thinking that interest rates, longer-term interest rates, will be on the rise. And in some countries, short-term rates will move higher. In Korea, 2 3/4% for the key policy rate could, because of the inflationary move, the strong growth of the economy, could end up over the next year, year and a half, as high as 4% before hopefully the inflation upturn resides Inflation depends a lot on food and energy, so economies around the world need to slow down to ease demands for the inflation to ease off. But it could be that the Bank of Korea will have to take interest rates up over the next year and a half, as high as 4%, to dampen the inflation that exists and is showing up at this time. But this is standard operating procedure in an expansion stage and should not abort set up conditions or bring about a recession. It's part of the strong growth. Interest rates tend to be pulled up by a strongly growing situation, rising inflation. And central banks' jobs during that time are to temper that, not to drive the economy back into a downturn. So, we do have legacies from the crises, and we do have risks around a relatively bright picture for the global economy. In 2011, we are estimating for the average of the 47 countries that we cover, real growth of 3.5%, at best 4%. That's for the global economy. That's a very good year. That would be similar to the growth rates of 2005 to 2007. It would put the deep declines of the crises behind, and there would be other policy issues and problems to deal with. For the United States, less growth than average, 3% plus this year, 3.5% plus next year. I call it a half-speed upturn, half of what we have done in many of our business cycle upturns, but good enough so that unemployment rate will gradually come down, not much, but come down. Good enough to permit companies to make outstanding profits. The S&P 500 operating earnings to be up in 2011, 15, 16%. That's quite good. And a high multiple of GDP growth because companies at this stage are very productive, are earning more and growing earnings faster than the overall economy grows. I would expect to see that for Korean companies as well. And in a world economy that is much more favorable to the exports of Korea and the basic items, commodities, electronics, automobiles that this country is so strong in producing and selling, and the next year to 3 years to be probably the best that companies in these areas have seen in many, many years. There are risks. One is the Eurozone sovereign debt crisis. And the question of when will it end and at what cost to economies and can it take down the global economy? I'll get into that some. The answer is it is a crisis. It's ongoing. It isn't going to go away. It is rooted deeply in the Eurozone arrangement and the struggle in Europe to figure out what is the best arrangement now to have in this unified set of countries and how to get there. And until that gets figured out, we think we will continue to see what has emerged as a divergence in the growth rates and the performance, a kind of two-tier situation for Eurozone countries. Germany, France, one or two countries doing very well, and a number of countries doing very poorly. It's part of the problem of a federation of countries that is not politically unified, does not have a common set of political rules to follow, having to operate in their economy with one exchange rate, one interest rate, and without full control, particularly if they have made mistakes on fiscal imbalances in the past, sovereign fiscal imbalances in the past, the loss of control of the ability to use fiscal policy to grow the economy. That's a very difficult position to be in, and that is the position that Greece, Portugal, Spain, Belgium is in, and we don't see that they can get out of it easily. We would expect more countries to fall in terms of their financial problems and sovereign debt, more countries to seek aid from the funding by the European Union and the IMF, difficulties in getting those funds and getting funds from the markets. And we are concerned about the banking systems and the exposures of banks to sovereign debt, and yes, the exposure of the European Central Bank as it buys sovereign debt to indirectly shore up the banking system, which is its job. But in doing that, it is buying very weak sovereign debt of a number of countries who do not have the ability to pay and have run into difficulties refinancing and funding what they do. This risk to the world economy on the economic side is ongoing. We think we will see flare-ups in the markets of crises surrounding the Eurozone situation, but we don't think it can do enough harm that what will happen in the Eurozone and Europe, all of Europe, in the injury to economies there can take down in a big way the U.S. economy. Our trade exposure is less. But out here in Asia, for China, South Korea, Japan, and because of the interactions of trade among so many countries in the Asia and Pacific areas, this is a significant risk with potential economic exposure. And for those of you in the financial markets, in investments, and those in business, you need to watch to see how this goes. A second risk is China's attempt to disinflate. Correctly taken, the Chinese economy has overheated. It is dynamically strong, grows faster than the Chinese government and People's Bank of China would like. And now, thanks to its growth and the strong growth of other countries in this part of the world and other factors, commodity prices have risen, and this part of inflation is showing up in the inflation indices of a number of countries in Asia. Countries are well advised in policy to step out and to lean against that inflation before it gets entrenched and goes too far and requires more punitive medicine later and problems in the economy because of that. And so I applaud the Bank of Korea's quicker than expected decision to raise interest rates just recently, because inflation in Korea at 3.5% historically isn't that high, but in terms of the targeted inflation, midway between 2% and 4%, it is moving in that direction. It starts with food and energy, commodity prices, but inflation can be a problem for an economy. Better to lean against it early by raising interest rates than to wait too long until it's entrenched in the system. China is also trying to do that, and we applaud the Chinese attempt to slow its economy down and think and are assuming in our bright outlook for the future, particularly for the Asian region, that China will be successful. But we don't know that. This is risky business. And here we have a country that has mainly been trying to drive growth higher without inflation as a worry, now facing that and attempting to disinflate. It's a kind of a soft landing that China is trying to achieve. Tricky business. It is particularly tricky business if a very natural break, B-R-A-K-E, the currency, is not allowed to rise, to temper and slow down exports, and in turn temper and slow down inflation. And at this moment, for understandable reasons, to me as an analyst and as an observer of history, I think I fully understand why the People's Republic of China is reluctant to let the markets take the Chinese currency to the levels the market would if it were freed and not tightly kept in a band and allowed to appreciate something like 5% a year. The motives are fully understandable for a country that 10 years ago was not in the position that it is now. But in its own interest, China as policymakers would be well advised to permit the Chinese currency to move higher, faster, as a tool to disinflate and to achieve a soft landing, to preserve and extend the expansion of the Chinese economy, and then to help the other countries in the region through its impact. We would be more confident about the ability to finesse this inflation problem if we saw that happening. Of course, I might say the same for other Asian countries who from time to time have intervened to prevent their currencies from rising. This is totally understandable from the point of view of companies in the region and the importance of the exchange rate in trade between countries and across the global economy. But when markets want to take currencies up, and let's put aside the trading and speculation and froth that goes on in these markets, when that is a part of the fundamentals of the dynamics of an economy, I think policymakers should let that happen and intervene to prevent destabilization, hot money flows, and non-fundamental dynamics from taking hold of the currency markets. Well, it's easy to say as an analyst and an observer, much harder to do when you're running a government and dealing with foreign exchange and the world and the kind of dynamics that go on in exchange rate markets. The Chinese currency will rise. We think China will let it go up a little faster than most people think, and we're projecting a 10% increase in the Chinese currency against the US dollar. And we are expecting Asian currencies, South Korean won, and other currencies in the region to rise on the order of 10% or more over the next year or so, reflecting the positive fundamentals in these countries. Yes, that will make, against some countries, exports less competitive on the cost side. But within the region, the currencies will stay fairly well aligned, and the intra-trade dynamics of the Asian region will not be damaged if most Asian currencies move up. The world financial community is much more interested now in Asia and investing in Asia and in the stocks and currencies of Asia than ever before. And money is flowing away. Funds are flowing away, sometimes too much, too fast, so-called hot money, capital flows, moving away from the big three currencies, the dollar, the euro, and the yen, into the Asian currencies as an alternative. And I don't think that's going to change. This and what is going on in the changing dynamics and economic geography of the world, the growing haves, strong countries of the world, of which South Korea is one, in our view. Singapore is another, China is another, Japan is not. The dynamics of who's strong, who's weak, who's wealthy, who's less wealthy, who's poor, haves versus have-nots, have changed immensely. And the money flows, as far as currency goes, reflect that. And so, as things now look, it seems to me that the currencies that have been the key reserve currencies of the world for so long, the dollar, the euro, and the yen, are diminishing in importance, and the currencies of other countries reflecting their changing role and position in the world economy and the world of finance are becoming more important, and a basket of them more likely to be increasingly major kind of reserve currency, along with certain commodities that represent stores of value, including gold. This is a very dynamic force and shift that is going on in the currency arena now. And I call that to your attention because as an economy that is so open, so trade-oriented, buy so much from other parts of the world, exchange rates, how they move, their tendencies, which exchange rates are the major, which currencies are the major reserve currencies. That is a very important matter here. In any case, the Chinese attempt to disinflate, we are watching closely. We think it's a bigger risk to the world economy. This is a risk now. Our basic forecast, you've heard, very positive. This is one of the risks. We're watching it very closely to see what happens. It's probably a bigger risk, particularly to the economies of Asia, than is the problems of Europe. A third risk is the rising inflation, the commodity price inflation, in part because of the demand for commodities, food, oil, energy that comes out of such a strong upturn after the crises that has occurred in Asia, and also comes indirectly from the printing of money, the quantitative easing of countries like the United States, Japan, to some extent the Eurozone, for a while the UK. The market reactions to QE2, the Federal Reserve of the United States' latest attempt to stimulate an economy that's far underperforming, is quite understandable. Our Federal Reserve has said, and it has no other choice, it has no other choice. The U.S. economy, according to the law of the land, Full Employment and Balanced Growth Act of 1978, the Full Employment Act of 1946, several other pieces of legislation, charges our central bank with achieving full employment and price stability. It's what we call the dual mandate. In South Korea, you have a single mandate, price stability. I think the policymakers do care about growth and would certainly not sacrifice growth for price stability in Korea. But in much of the world, the price or inflation goal is the key one for the central bank. Not in the case of the United States. Our Federal Reserve has to carry out the law of the land. The central bank can define what full employment means, can define what price stability means. It can choose the numbers. A lot of research goes into that. The law doesn't tell them what those numbers are, doesn't mandate what the numbers are. The Federal Reserve defines full employment now as something under 6%. It's their latest number. The Federal Reserve defines price stability on the inflation measure called the consumption goods price deflator, takes out food and energy, and defines price stability as 2% on that index or a little less. Looking at the performance of the U.S. economy, the unemployment rate is 9.4%. That's 3.5 percentage points higher than full employment. The output gap in the United States is 6 to 7%. We are not growing much above our potential, which is 2.5% a year. And the core inflation rate is running 0.5 to 0.75% on a year-over-year basis. The law of the land says achieve full employment and price stability. On performance measures and the definitions, the U.S. is nowhere near that. The central bank has to stimulate. It has. The Federal Reserve took interest rates to 0 2 years ago. U.S. economy is where I have described it today. That didn't work. The Federal Reserve took extreme actions, things that central banks would never do, to preserve a consolidated financial system, to keep the flow of credit going, and pumped tremendous funds into the banking system, which sit there, not used, not being lent, not being borrowed. And so the credit channel to the economy, that didn't work. Look where we are today in terms of the goals. And so the central bank now is using its balance sheet, and for the first time in history, actively buying long-term Treasury securities and increasing its balance sheet in the market to directly impact the long-term rates, something our central bank could never do has never done in its history. If this doesn't work, they'll think of something else. If that doesn't work, they'll think of something else. It's very straightforward. Chairman Bernanke has a job to do. The law says full employment and price stability. Unless the law is changed, or we redefine the parameters, and the Federal Reserve have redefined it, the central bank will continue to press and push to raise growth, lower the unemployment rate, and to raise inflation. In the markets, if you know that, it's straightforward. You buy inflation-hedged assets. You understand that if the Federal Reserve gets its job done, that there will be more demand, commodity prices will rise, and you buy, even before it happens, commodities. Because the printing of money, which is what the extension of the balance sheet means, suggests more dollars in the currency system, you sell the dollar and buy other currencies who have promise. And a falling dollar, we think, raises crude oil prices. It isn't the demand for oil and supply of oil that has oil in the 90s. It, in part, is a financial asset where countries pay their debts in dollars and the currency is depreciating, and so they adjust supply to keep oil prices higher to offset for the declines in the manner in which they pay. In addition, I think oil, crude oil, is now in portfolios, the foreign exchange holdings of countries, because crude oil has become a store of value, at least for now, just as gold is. Gold is a store of value. It's an alternative to the dollar. These are very logical things for financial market participants and the financial markets to do. And in addition, it's quite expected that stocks will be an asset of choice. Stocks, in the early stages of an expansion, are an inflation hedge asset. Inflation helps the revenues of companies. If there is slack in the labor market, labor costs don't go up, they're held down. Profits move higher than they would otherwise. And stock prices price on earnings and interest rates. And so the stock market goes up, and that feeds into more. Now, in the quantitative easing of our Federal Reserve, explicit recognition is now being paid to what I have just said. Our central bank cannot and will not say that they are purposely trying to lower the dollar. But a lower dollar is a consequence of the actions they are taking in the name of achieving full employment and price stability. That is not an explicit objective of the Federal Reserve to move the dollar down. It just happens as part of the reactions to the policy they're taking, and it is part of the mechanism by which the U.S. economy will grow faster and the central bank's objectives will be achieved. The lower currency helps exports. Exports are strong and growing, one of the strongest areas of the U.S. economy at this time, and doubling exports is a goal of the Obama administration. In the U.S. economy, we think we will see very strong exports for quite some time now, and the U.S. may someday compete more with countries on exports than it has in decades. So the QE2, I will tell you, quantitative easing, the Federal Reserve are on a mission. The bulk of the members of the Federal Reserve agree with this, committed to it, in the name of moving toward full employment and price stability. And not until they see significant progress in those directions will they exit from this printing of money, and the dynamic ripples that flow from the printing of money in the U.S. will continue. And part of that is in the inflation of a number of countries in this part of the world, because commodity price inflation shows up more in inflation in Asia than probably anywhere else. The commodity price content in the U.S. inflation indices, major ones, the ones the Federal Reserve watches, is almost nothing. It's a cost, but companies are managing to absorb costs and still be productive and get good profits. It is not a factor in inflation in the United States, but it is here. And what I'm saying is, because of the QE2 of the United States, because Japan is also quantitatively easing, effects to hold up and lift commodity prices are likely to continue. And one of the byproducts, this is not the only reason, is the Bank of Korea will have to probably raise interest rates to temper the inflation. It would be a lot better if the Chinese currency were allowed to go up and the Chinese economy slowed down, some of the demand slowed down, but that isn't what we expect to see happen. We are already out of the consensus in expecting the Chinese currency to go up 10% over the next year. We are already way out of the consensus on that. The forecasts are somewhere around 5%. The risks from the U.S. itself to the world economy are much less now than a year ago. The U.S. economy is not going to drop into a double dip. U.S. consumers, though they are not spending the way they used to, they are saving more, taking down debt, are not going to cave in. The U.S. economy isn't just going to go and drop into a recession and bring down the rest of the world. If the global economy runs into problems, I think it'll be more from outside the U.S. in the areas I've mentioned than from the U.S. There are always risks of shocks. Crude oil prices shooting way up, $50 a barrel. For some reason, geopolitical problems can happen. Here in Korea, there is tension. I feel it. I'm not sure the South Koreans, it's a mixed picture of the reactions here, but the tension between North and South Korea is an issue. I think the tensions, supposed tensions between China and the United States are minimal. China is a huge force on the world economy, politically, economically. I see much more opportunity for collaboration and joint efforts that will benefit the world economy and enhance world peace, and increasingly China actively signing on to that kind of approach as opposed to confrontation with the West. Very encouraging. The meeting between President Obama and Hu Jintao is to me a positive sign, not a sign of tension and two individuals representing two countries where there will be conflict. Of course, the United States and I as an economist would advise China, let the currency appreciate more. But as an economist and a political observer, I respect and understand why they don't. Until the Chinese economy makes a transition to a consumer-driven economy, from the point of view of China, it isn't safe to let the currency go up 30 or 40%, which is what the market would do if they freed it up. It would be too abrupt. It would be disruptive. And if you run a country, you can't let that happen. Indeed, if the country has made its way as an strong export country, yes, perhaps to the annoyance of South Korea and Japan because of the conflicts of competing with a formidable competitor like China. Yes, of course, but they have made their way in the world, as did Korea, as did Japan, as did Germany, through exports. They've made their way in the world and have gotten very rich, at least on the country level. $2.8 trillion foreign exchange reserves, the ability to fund all kinds of investments all over the world, indeed to make loans to developing countries that are in excess of the loans made by the World Bank. That's a positive force. So, formidable competitor, strong country, but I'm quite optimistic about where this takes the world and the world economy and where we go politically on that. Much more worried about confrontations and geopolitical events coming out of the Mideast, coming out of strange behavior of the leaders of North Korea, out of Iran and Iraq and the conflicts between Israel and the Middle East, nuclear accidents as a result of that and impacts on economies. Those are the kinds of things people like me think about. But this doesn't mean in the sense of what could go wrong. We're not expecting anything like that to happen in 2011, 2012. Let me say another word or two about markets and to reiterate and underscore what I said about this stage of the expansion and what that implies for financial markets and the returns on financial investments. It's clear-cut. In this stage of the business cycle and the financial cycles, stocks are the asset of choice. the sharpest gains in stock markets have already been made in a number of places. That is part of the recovery. And most investors are not aboard at that time. They're scared. The expansion is a safer stage. The expansions in the United States have gone on anywhere from 2 or 3 years to as long as 9 or 10 years. We're less optimistic this time about how long the U.S. upturn goes on than we have been in the past, the main reason being the sovereign debt problems of the United States are huge deficits relative to the economy and the huge sovereign debt that we have. We only hold 50% of our own Treasury debt. Right now, the U.S. fiscal position looks untenable and irresponsible. But we will see what goes on in Washington this year and whether the country comes to grips with its deficits and debt, particularly on the U.S. sovereign debt situation. But for Korea, for Singapore, for the countries in Asia whose expansions probably will last for years and years, unless something happens from outside to derail it, we're even more bullish. This stage of the business cycle, stock prices go up on average. The asset allocation weighting has to be overwhelmingly in the basic asset classes to stocks. Also, as I mentioned, in the expansion, interest rates begin to rise. We're seeing tastes of that now in a number of places. And so fixed income allocations, we think, should be underallocated to benchmarks because there's a loss of principal when interest rates rise. And also the returns are higher in stocks. So there is a natural switch from fixed income to equities that goes on in the expansion. It's part of where we are in the business cycle and in the financial cycle. In many countries, the return on cash and equivalent is essentially zero. So we are allocated zero in the United States to cash and equivalent. Zero. We want to invest all our funds. We're confident that we're in a business cycle upturn that will last. This is the view of the world. And so we are not so worried about being safe and owning cash when the returns are so low. The returns on deposits in South Korea are very low. Even if the Bank of Korea were to take its key rate up to 4% and increase the returns on cash and equivalent that way, we would expect the stock market to produce returns far in excess of returns in cash and equivalent. Yes, we would have some allocation to cash and equivalent here in South Korea, but it would be underweight. We're also bullish still on gold. This is now 9 years for us bullish on gold. Gold is not being bid up because it is a commodity. That's part of it. Its price is being bid up because it is an alternative as a store of value to currencies in a situation where the major currencies of countries and regions in the world, the dollar, the euro, and the yen, are backed by countries and regions that have tremendous problems. Tremendous problems. And so gold is an alternative as part of a basket of currencies, the holdings of which are unfamiliar, never before seen as safe alternatives to a currency like the dollar, but today, safe alternatives. The Singapore dollar, the Australian dollar, the South Korean won. South Korea is a clean country. You do not have a sovereign debt problem. You are running a relatively responsible fiscal situation. The economy grew more than most people expected last year. Earnings are following the strength in the economy. Interest rates will rise, but gently so. You are managing your position, growing dynamically quite well. I can tell you among some of our clients, the yuan is a preferred currency because they are looking for alternatives to the dollar, to the euro, to the yen. And beyond the comments I've made about these three currencies and the countries and regions behind them, it's very clear that there's so much uncertainty in each of these areas that these currencies are tarnished. And so investors are looking for other places to go. And in this part of the world, the Chinese currency is yet another. We have clients who, as part of a diversified alternative to dollars or euro or yen, are attempting to include the Chinese currency as part of a basket of currencies. We think the Chinese currency can only go up, it can't go down. We are actually advising this. I personally own Chinese currency. I can do that now as an individual, even on a small basis, in New York. And as a protection against the dollar risk of a sovereign debt crisis, one of the places I am hiding is in the Chinese currency. Never before have I seen anything like this. Swiss franc is another. Canadian dollar in North America is another. Latin American currency is a little difficult for me, but this is a mixture. Throw in a little gold. And investors are hiding out, diversifying their holdings of foreign exchange in their investment portfolios. Investments are following these moves until they see what happens in the U.S., until they see what happens in the Eurozone, until they see whether Japan can ever deal with the structural and the economic and societal problems that Japan has. So I note this. I can't to this audience advise it. I note this because it's one of the most striking facets of financial markets that is going on as we speak, and does appear to be a seismic shift from which there will be no return. 3 to 5 years from now, which countries will be the haves? Which countries will be the have-nots? The have countries will have strong currencies. The have-nots will have relatively weak currencies. The have countries, as I look at the parameters around trade, current accounts, fiscal positions, growth rates, the policies of countries, monetary and fiscal, the fiber of a society, its ambitions, the political stability or instability, I am seeing as the haves, emerging haves, countries that 10 or 15 years ago were the have-nots. It is an extraordinary shift in global economic geography. It goes on. I see it in anecdotal ways every day. As a citizen of the United States, I am concerned about the future of my country because the United States, with $93 billion of foreign exchange reserves, that's about the foreign exchange reserves surplus that Malaysia has. The United States, with a 10% deficit to GDP ratio after our latest fiscal stimulus, which was deficit financed, has the highest deficit to GDP ratio of almost any country except for 1 or 2. And with gross public debt headed to over, on our numbers, over 100% of GDP within the next 2 or 3 years, if nothing is done in Washington. That debt overhang, like the debt overhang of Japan, will compromise our ability to grow and make the dollar less attractive. South Korea, I think, we'll have to check the numbers, is something like $300 billion of foreign exchange reserves. China has $2.8 trillion. Japan is $1.1 trillion. I would much rather be in the shoes of those countries in a momentum motion sense than in the shoes of the United States with relative to GDP almost nothing in foreign exchange reserves and a continuing current account deficit and the kind of deficit position that we have. As an investor, why do I want to own dollar-based assets in my portfolio 100%, given this contrast between the quote, unquote haves and the haves that now are looking as if, and this has been going on for a number of years, they're moving in the direction of have-nots. The tides of history are changing. South Korea, while relatively small, though you're 12th or 13th on the ranking on our 47 in terms of size relative to global GDP, is in a very positive position looking ahead. So I congratulate you for whatever it is that has led to this. Some of your competitors are faltering. That's part of it. But the country is doing a lot of things right. The people are enterprising, hardworking, well-educated. Education is stressed in this country. I think the future is very bright here, very bright. Thank you.
Thank you very much for your very good stories about the world, not only world, but South Korea too. I think it's very stimulating. In a way, I think our president, Myung-Bak Lee, should be here to listen to Rosie and probably I will send it to him. Anyway, it was two good stories, very stimulating arguments and goods and bads about the world economy, stock markets particularly. And all of us are allowed to be proud of Korean situation. That's a good point. And a lot of clouds, I think, been cleared by your arguments and stories. So now we are going to have some questions from the floor. The Q&A session is always it's very interesting, and but let me say that his schedule is now after our talk. He will have a press conference, and then he will give a small seminar in another institute for a short time, and then he will have another press conference, and then he has to leave at 1.
Thank you very much for your very good presentation and sharing your good wisdom with us. I have 2 questions about the sovereign debt problems. Very recent issue of a British magazine Economist, it said that it's a good time now for Ireland, Greece, and Portugal to restructure their sovereign debt. The interest rates they are paying is too high, and they are not afford to continue paying such high interest. I feel rather very curious about that. What kind of structurings they can have, and what would be the risks and effect to the global economy and the global financial system. My second question is that Japanese fiscal debt is exceeding 200% of their GDP. While, of course, their country itself is not creditor country, but no government or no borrower can afford to pay interest and principal with that much high debt. I would appreciate your thought on that. And especially I feel rather curious why that global credit rating agencies and no global economists expressed worries about the Japanese government debt. Thank you.
A logical next step, and one that is likely in the debt situation in the Eurozone, would be a restructuring of the existing debt to a longer term and lower interest rates over a longer period of time by the debtor countries with the creditors. I do think that is bound to happen, and it's the step often before there is default on debt, if the situation does not get better economically and financially. The countries you named do not have the ability to repay the debt, will at some point this year run into additional problems of financing or interest rates that are so high in the markets that it will not be a viable situation, and are likely to go to the restructuring algorithm. And it may be that other countries will end up there too. Portugal has not yet asked for funding. I personally think that's a waste of time. They might as well restructure the debt now, and the policymakers of Europe should allow that to happen. and should permit the creditors on the bond side, the sovereign debt side, to take a haircut in terms of lower interest payments and lower costs to the countries at hand. The European Union has set 2013 at a time when they will permit that to happen. They would be well advised to let it happen sooner rather than later, because it probably will happen anyway. We don't see, for those countries at the moment, we don't see any way out. The euro is too high to help the exports enough of the countries that you named. The interest rate is too high, even though short-term rates are 1%, but their long-term debt interest rates, Portugal, 7%. Too high. That makes the situation worse. Because of lender conditionality, they have no control over fiscal policy. Fiscal policy is one of restraint. How can a country grow out of its situation in such a position? It can't. So the problem gets worse or doesn't get healed soon enough. What does that mean for an investor? Do not own the sovereign debt of any of the countries who have sovereign debt parameters, even if terrible things have not yet happened. There are plenty of other fixed income securities to own. Do not own the debt of banks or fund the banks that are exposed to sovereign debt-ridden countries. And if the European Central Bank had a bond, I wouldn't buy the bond of the European Central Bank, because they've taken on their balance sheet, I understand why, all of this very bad debt. And I would not buy, do not own, directly, perhaps indirectly, some U.S. Treasury debt. Now, and I certainly would not own Japanese JGBs or even short-term government debt of countries that have the financial parameters of the countries that I have named. I would rather own in the United States top quality corporate debt of a company who is making good money, has a lot of cash, a strong balance sheet, and is running their business wisely. I cannot say that Washington runs its $3.5 trillion enterprise wisely. Washington is, I have to be careful because it may be pressed here. Washington is fiscally irresponsible. No less so, in my view, than Greece, Hungary to some extent, Portugal, Spain has been. And the U.S. and Japan live on, despite that, in the markets for reasons. In the case of Japan, most of the Japanese paper is owned by Japan. So the Japanese people are sitting with low returns, holding the paper of the government that has a horrible budget situation, and they are suffering because of that. The Japanese economy cannot receive enough stimulus from the government because it has too much in the way of deficits and debt. And in part, the Japanese economy grows slowly, does not mount a dynamic upturn, despite the vibrancy of Asia. Japan is a big exporter. But the Japanese economy is fading now. South Korea's economy might fade a little bit. Quite a difference. And in the United States, we cannot stimulate our economy to grow our economy much faster to lower the unemployment rate because we can't afford it. And that is going on in Washington now. We can't afford it. And someday, if we keep on deficit financing our economy's stimulus, fiscal stimulus, the 10-year Treasury bond, which has risen in the last month or so, will be double. The current 3.32 or so percent, it'll be 6%. And our government will be straddled with huge interest payments on the huge debt driven by the huge deficits that we run. So, neither I nor anybody here can change what countries are doing in their fiscal actions individually. No one of us can do it. But we can move our money. We can move our funds in the interest of our own balance sheet. And from a risk point of view, I think you see the implications of what I'm saying in terms of where you might be positioned on fixed income or even in equities.
For not only giving us extensive global overview, but also your reference framework of the business cycle. Very helpful to know where everybody stands on that. One of the topics here in Korea, of course, is the raising of interest rates as a mechanism to stem inflation. I understand why raising interest rates in China to slow down the economy can have an effect on demand for commodities. I can understand the same thing in a US context, historically. But as Korea is not a producer of commodities, is only an importer, and is not a major driver of commodity prices globally, I actually don't understand how raising interest rates in Korea will have any direct effect on reducing inflation in Korea, unless it's to drive up the strength of the currency, and therefore effectively change the reference price that you're paying in Korea. But that, of course, then translates into less competitive exports and slowing down of the economy. And so, are we basically saying when we raise interest rates to affect inflation in Korea that we should just slow down our economy from the 5% perhaps to 3% to try and offset? I have difficulty with that policy. I don't think Korea can affect the prices that it faces for global commodities. And there's a lot of food has to be imported in Korea too, because we're not a major agricultural nation. It seems to me the same problem there. Could you comment on that for us?
And have very little effect on the source of that inflation. The inflation can go on, and the economy weaken, and the interest rate hikes don't do much. But there is not much choice available for a central bank facing inflation from any source that is above the targeted rate. And there is no choice. If the central bank does nothing, the central bank loses credibility, and the source of the inflation may spread into other parts of the economy because the central bank does not take action to slow things down or to signal their stand against inflation from whatever source. If interest rates are raised too high and the source is this outside kind of inflation, then the risk is overdoing it. This is the risk China runs, hurting demand and the economy and not taking inflation down, or hurting the economy so much that 2 or 3% is the outcome, and then inflation comes down. The preferred strategy is to step out in a gentle way against such an inflation and to periodically raise short-term rates, policy instrument, and then to hope that the source of the inflation, commodity price inflation, diminishes, and not to injure the economy too much. I think an obvious implication of hikes in interest rates has to be an understanding that the currency of the country may rise, but the strategy would be to hope and perhaps to take actions. And this is not for the central bank, this is for the government, actions that would try to keep the appreciation of the currency gradual. The currency does have to go up, and that in turn is part of a gentle, hoped-for breaking process to ease the inflation. Let everyone know the central bank stands against inflation, so inflation expectations don't get out of hand, and hope that the sources of the inflation fade away. Now, if none of that happens and it stays, gets worse, then the central bank has to deal with it and devise a different strategy. As I perceive the strategy here, this is pretty much it, with one extra dimension, which I think is wise. It is to take actions on the supply and demand side in the markets where the inflation is occurring. It's tricky business. Medicine is tricky. If you fix prices, the history is it doesn't work very well. But to affect the supply of a commodity, to take actions to induce an increase in supply, or in the specific areas where the inflation is cropping up, to slow down the demand, I think is a good kind of medicine to try. And then, like any doctor, I'm a doctor, I think about medicine for economies all the time. They all have side products. The art of economic policy making is a lot like the art of medicine. It is complicated, as we know, by politics, which often muck up the works. But nevertheless, there are these gradations of judgment. So South Korea is, I think, initially attempting the right thing. So is China. The problem with what China is doing is the currency is extremely undervalued. The yuan is not extremely undervalued. It's been kept lower than it would otherwise be by the periodic convention that's going on. It will go higher. It's a sign of strength, not a sign of weakness. And the response of the private sector then to be competitive, when it is losing competitive on the price side, has to be get more productive. The response of policymakers is to provide incentives to be more productive. The private sector does it on its own. If this country doesn't use technology, in which it is a major producer, in production to offset the rising costs induced by the yuan, I would be amazed. Of course the country will. And so I will continue to be optimistic on that growth rate, even if the Bank of Korea takes interest rates to 5%. I don't think they'll do that, but I think they will have to take them up.
My name is Sir, journalist. President Hu Jintao of China is going to meet President Obama, and America is offering unprecedented special treatment to Mr. Hu. So in this context, I'd like to know how much, to what extent China is important to America in terms of economics, and whether American politicians can influence Chinese leaders to take the economic policies that they want.
It has moved from 7 or 8, 10 or 15 years ago to number 2. Japan's nominal GDP is lower now than it was 7 or 8 years ago. China is a developed country. It is not an emerging country. China is a major force. We have G20 now, 20 countries in the international policy-making arrangements that go on. We no longer have G7 or G8. Ilse Kong has been part of that motion. It reflects the reality of the world. The reality of the world means a power such as the United States and a power such as China need to talk, collaborate, discuss differences, similarities, and attempt to work together to use the resources and energy of their leadership and country to make the world a better place for all global citizens. These are idealistic comments that I've just made. But we Americans still are idealistic. President Obama is idealistic, and that may have hurt him politically in our country with some of the objectives. It is absolutely the right thing to do, and to shower Hu Jintao with attention, to flatter him, to let him know that the United States cares and is interested in talking to him, is to me not a sign of weakness, it's a sign of strength. And an attempt to open the conversation and to work together on common problems. The differences on the currency are not solvable at this time. To tell China, and to say, as I said, that they would be well advised in their interest to let their currency appreciate more, that's part of our forecast. I think they will do that. They will respond. But China will say, we don't want to do that. We want to protect exports because we want to protect jobs and our people. That's a natural tension. If I were Hu Jintao, I would have the same view. But without the dialogue, without friendly conversations, and sometimes unfriendly conversations, when something happens like North Korea raising its hand and threatening South Korea, the United States, perhaps the staunchest ally for so long of South Korea, standing with and behind South Korea, President Obama will call up his friend, Hu Jintao, and ask, can you do something about this? Oh, it's so important. It's so important. So I would not expect miracles in relationships and differences to go away. I would not expect China to give up its ambitions in the region and world. I would not expect China to deter and stop using its foreign exchange from buying oil here, infrastructure there, establishing branch banking all over the world, its ambitions, mercantilist and other. I think that's just the way they will be, and everyone will learn to compete, and hopefully the competition will not end up as military competition, confrontation, but can have the other result. So I like to look at this as a very great opportunity to see a country like China 15 or 20 years ago, a have-not. In my definition, now a have. Becoming a part of the global citizenry, much more law-abiding, although its competitors don't think that. Much more law-abiding, much more civil, doing more on the environment and energy in a country that needs a lot of work in its environment and energy than the United States is doing. More greening in China, of course it's huge in absolute numbers, and the force that it is in terms of what it can mean for economies all over the world. I'm excited to see what's going on. Well, it's now evening. They're probably having a state dinner now. And, we'll be disappointed. None of these things go smoothly. But just think of this as opposed to Red China, going back to the early 1980s, and the Cold War that was engulfing the world. Oh, yes, we have horrible things going on in the Middle East, atrocities, Iraq, conflicts all over the globe, but not a major power conflict that would envelop the globe and virtually destroy the potential future of a country like Korea.
Yeah.
네, 질문 드리겠습니다. 질문 두 가지고요. 예, 첫 번째는 아까 말씀 중에 그 미국 경우에는 회복기에서 팽창기로 접어드는 과정이 한 1년 반 소요된다고 하셨는데 객관적인 근거를 좀 제가 여쭤보고자 하고요. 두 번째는 그 이머징 마켓 통화 대비 달러가 이제 같이 하락을 전체적으로 보이는 추세고 향후에 이제 저희 나라도 그렇지만 평가 절상을 예상을 하고 있습니다. 국가 정책도 그렇고요. 그런데 이제 그렇게 됨에 따라서 수입 물가는 분명히 이제 안정화에 접어들 텐데 그러한 이유 하나와 또 하나는 또 헤지 펀드가 아직까지는 원유의 그 투자 비중에서 상당히 절대적인 우위를 점하고 있습니다. 그럼에도 불구하고 아까 말씀 중에서는 원유가 달러 대비 그 금과 함께 대체함으로써 상당히 유효하고 유의성이 있다 이런 말씀을 하셨습니다. 그 부분에 대해서 좀 저는 이제 반론 아닌 반론을 좀 제기할까 하는데 답변을 좀 부탁드립니다.
Yes, let me take oil first. I think it's perfectly fine for you not to agree with the view that oil and oil prices to some extent are reflecting its presence in portfolios by traders and investors as a store of value and an alternative to currencies who are expected to lose value. I see that, I perceive it. It is going on. How empirically significant it is another question. And it is arguable and legitimately debatable as to whether $91 for light crude oil, how much of that is coming from this phenomenon. The first part of your question was on the improvement in the U.S. economy and the weakening of the dollar. Normally, an improving economy would help a currency do better against other currencies. An improving economy suggests at some point higher interest rates, and higher interest rates, relative interest rates, are a major fundamental in currency pricing. The difficulty for the dollar, I believe, lies in its deficit and debt position, and the risk that holders of dollars face when they look at a country in that kind of fiscal position and wonder if the dollar holdings will hold value if the country continues that way. Countries that have continued to run huge deficits and growing debt relative to GDP eventually have had declines in the currency. And so it is increased growth in the United States only momentarily helps the currency. If we were to take actions to fiscally consolidate in this next 6 months or 12 months, there's a chance of that. I think the dollar would do very well. And I would be less bearish on the dollar than I am today. I'm not quite willing to buy the dollar now on the chance that Washington will get fiscally responsible. We have a very poor record on that. I don't want to take a chance. But it's interesting, if you look at the pound sterling and look at the euro against the dollar, they're doing well. And why is the pound sterling doing well against the dollar? Doing well because they are fiscally consolidating in a serious way, in my view. Sacrificing growth, but getting their fiscal house in order. To some extent, the Eurozone is doing that as well. Now, the euro has been up and down and all around. I don't think it's going to go up permanently against the dollar. But lately it's gotten a little stronger. So it will ebb and flow. Fiscal consolidation is a source of strength. The puzzle in the currency world is why the yen is so strong against the dollar and the euro. But I think, and I was just in Japan, the consensus is Japanese hold their currency, keep demand up, that keeps the yen up. It is not. It is diminishing in its role as an international currency, as is the stock market capitalization weight of Japan in the MSCI Global Index. It just is not a place that we can say you should invest in stocks. We continue to be underweight in our weightings on Japan, which goes actually back to the initial question you asked. So thank you all for your questions. They're great questions. It's been a pleasure and a delight for me to see you once again. Bright, sunny, but cold days in Seoul. I come from the Northeast, and if I don't see snow, it's a good day.
Okay. Thank you. Your closing remarks. And thank you for being with us.
Thank you.
We hope to have you on another occasion,
Oh, it's very nice.
perhaps next year.
Thank you.